Hey everybody, Todd Seymour for another session on Let's Talk Money. And today is definitely a teaching lesson on the things I learned during tax season. And I like to do this for my clients every year after tax season gets done to kind of show you what other clients are making mistakes at and how we can fix them. I People ask me all the time, especially my wife, why would you do taxes on the side for a living? And I said I've been doing it 27 years, and especially in combination with being an investment advisor, it definitely helps my clients that we take care of, because if I can find a client that makes a mistake like some of these, my job is to make sure that none of my clients make that same mistake. So one client makes a mistake, my 500 plus others don't make that same mistake. And the more I do this for a living and I see things, I definitely point out. And again, some of this stuff is from my personal opinion, and I definitely say it like it is. And I try to think sometimes how the clients feel, but a lot of these things I want to go over and make sure you kind of understand where I'm coming from too. Uh, the first one is having too many bank accounts. And I'm not exaggerating when I say I had one client this tax season have 17 bank accounts. And yeah, probably a little overkill, I would say. The biggest thing, especially when you deal with estate planning like we do, is I tell people all the time, you don't want to leave your kids or your successor trustee or your personal representative on a scavenger hunt. And there's no reason in today's world, especially with FDIC protection at $250,000, for you to have more than one, possibly two bank accounts, especially if you are still a snowbird and go back and forth between Florida and other states and up north. There's just no reason to have multitude of bank accounts. It just causes confusion, not only for you as you get older, and that's some of it where I see, to be honest with you, is many clients that we have are getting a little bit older, and when they have too many things, it just adds to confusion. And when your kids or your spouse that sometimes never handled money, or a family member takes over, you're going to add confusion to those individuals. And sometimes it gets very frustrating to try to pay bills and take over and help things out. And this is one of the reasons why I think just having too many bank accounts in today's low interest environment makes no sense whatsoever. So stick with a bank that you're loyal to, that treats you well. Especially in today's world, you're not going to find that too often. Customer service is definitely not the way that it used to be. So one, no more than two bank accounts. Second one is, I see this often too, is I ask when I'm doing tax returns, I always ask for year-end statements. And the biggest reason is just because I want to point out some of these things. And one of them is, if you own a variable annuity, make sure that you're reviewing what is inside that variable annuity. And what happens is, a lot of times you'll have somebody sell you this annuity, and temporarily they'll put it into cash until they can make investment decisions inside a variable annuity. And variable annuities, just so you understand, can own mutual funds and ETFs inside that variable annuity. It goes up and down with the market. And many clients this tax season, when I'm reviewing their variable annuities, the money is still sitting in cash, and sometimes 5 to 10 years after they bought the product. So think about what the market has done for the last 5 or 10 years, and that money that they put inside a variable annuity that they're paying pretty high fees is earning nothing because it's sitting in cash, because nobody has ever reviewed that annuity. So that variable annuity should be reviewed by your advisor or the person that sold you that annuity on a at least semi-annual basis. It should be managed because they're getting paid a fee. So making sure, again, that we review these. Tax season is such a good time to review things too. All your documents are out. You're getting year-end statements. Great time to do that. Number three, and maybe I'm a little biased on this because, again, I'm being an investment advisor, but having multiple brokerage accounts. And by that I mean I have some clients that have two. Okay, that's not overkill. But I have some clients that have 5 or 6 brokerage accounts. I cannot even imagine the amount of paperwork that they must get. Um, Most brokerage firms today can hold everything. And that means they can hold Vanguard and Fidelity. They're what's called usually an open platform type of account. And clients will push back to me when I bring this up and say, yeah, but I don't want to have all my eggs in one basket. I hear this all the time. Your eggs are not all in one basket, just so you understand. If you own a Fidelity Advisor New Insight Fund, for example, and it's held at Fidelity, it doesn't matter if you transfer it over to another brokerage firm, it's still the Fidelity New Insight Advisor Fund. You're still holding the same fund, still holding the same stock. The custodian, which is the brokerage firm, whether it's TD Ameritrade or Charles Schwab or Raymond James, it doesn't matter. They're the ones that hold your money on behalf of you. And it doesn't matter if you have 5 brokerage accounts or 1. The problem with having so many brokerage accounts, again, leaving the kids on a scavenger hunt. A lot of times what I'll see is if a client passes away, the brokerage accounts that we manage, we step up cost basis. So when we pass the assets on to the kids, they pay less taxes. Other firms don't do that. So you're creating so many problems that I don't think people understand by having so many different accounts. Your investments are probably overlapping each other, so you're not diversifying yourself. Even though you've got 5 or 6 brokerage firms, you're probably doing yourself more harm. You're thinking that you're more diversified because of that, and that's usually not the case. It's the other way around. Your fees are probably so much more higher because you've got multiple accounts with balances under a certain amount, and if you had them all into one brokerage firm, you probably could get discounted fees because of that. So I can keep going on that. That's a big stickler to me, just because, again, you have to take a step back and ask yourself, what's the point of why you have so many different brokerage accounts? Number 4, again, kind of piggybacks on that a little bit, is not understanding your investments, and again, being overcharged. And I talked in another video about mutual funds and share classes and how you're paying your advisor. And a lot of this, to be honest with you, is, yeah, it's the advisor's job to make sure that they tell you in the beginning what your fee structure is. But admittedly, most of us forget. And you just kind of get so busy with life, those things never get reviewed. And when I'm doing tax returns, I tell people all the time, it's your financial underwear of everything. You can't hide anything. And to me, I just try to give advice on what I see and talk to clients and make sure that they understand how they're being charged. So one example that I had on a tax return was the client was getting charged an investment advisor fee, which is fine, right? They're getting charged like a 1%, let's say, and they're being charged on that. But inside the account, they were actually getting charged on their fund purchases too. So they were buying A shares in an investment account, which is illegal. You're basically, that advisor at that firm was double dipping on that client, and the client had no clue. And so you got to make sure that you review your portfolio. And if you don't understand, the thing I talk to clients about all the time is, when I ask them if they have any questions, they usually say no, because they don't know what to ask. And so one of the things that you need to definitely openly discuss, and you should not be hesitant on it, is how you're being charged, because it's your money. And so you need to understand that you're being charged on that it's fair, basically. So number 5 is, and I don't mean to beat on anything, but it's taking financial advice, and I underscored financial, from banks. And the reason I point this out, again, no offense to anybody at all, is that banks are salespeople, and they have an insight to what you have in your investments. And many of you listening to me will agree that if you have an excessive amount of money in your account, they are going to try to sell you something, and that is usually an annuity. And I remind people, again, I have my insurance and annuities license too, and I sell annuities. It's definitely not my primary thing to do. But banks will make anywhere between 2 to 8% commission on what they're trying to sell you. So when I say an underscore financial, it's because I think banks are more salespeople than banks. And the problem with buying something at a bank is the amount of turnover at these banks. So you're going to get pushed by a teller to go meet with an advisor at the bank. They're going to try to sell you something, and if you buy that, then when you need help down the road, more likely than not, that person's not going to be there because of the turnover at banks. And you're not going to get the customer service, and now you're stuck with something for 5, 7, 10. I've seen clients buy 15-year surrender annuities from a bank. And you're stuck in that investment for whatever surrender period that is. It's not a good avenue to take. Banks definitely are not on your side of the table, I can promise you. Number 6, not having your investments or your accounts in an active trust. And what do I mean by that is many clients have in existence a revocable living trust, and they have set that up to avoid probate and pass assets on to their beneficiaries. And they don't necessarily have everything inside that trust. So, and I can usually tell just by looking at the 1099s, and that I give advice all the time to clients on. Sometimes it's I had a client the other day, we were meeting, and they sent me all the information, and all the brokerage accounts were in joint name, and they had no beneficiaries on there. So I sent them an email. I know they didn't have a trust. And I just said, you should just make sure that your brokerage account is titled as a TOD, or a transfer on death. And that way there's no probate. And so the client called the advisor, they switched the account up, and now everything's taken care of. All the beneficiaries are proper. Just look at your 1099s and see what accounts are if you do have a trust, if they're made out to you individually or jointly, or if they're made out to your trust. If you have a trust, you should confirm that the account is in a trust. It's what's called funding a trust. If you have a trust and a non-retirement asset is not in a trust, let's say it's, again, a brokerage account, homes. I've seen homes where clients will refinance their house and it kicks it out of the trust name. You got to make sure that the account is retitled into the trust, so that way the trust owns it, so it avoids the probate. The whole reason why you set that up. The last thing is, because there's many more, trust me, but I don't want to keep going. The biggest thing that I see, again, from the tax side of it and the advisor side of it is I jokingly say that tax people know taxes and advisors know financial advice. That's what they're good at. Those are their specialties. Where I'm a rarity, that I have the best of both worlds. So I try to give advisors the insight to help them make distributions to their clients. And what I typically see is that if you have a retirement account and a non-retirement account, whether it's in a trust or a joint name or just your individual non-retirement name, when you call your advisor and ask them for money, you'll talk to the assistant, and that assistant will typically grab money wherever there is cash, whether it's a retirement account or not, because they just know that you need $10,000 because that's what you need for a home improvement or whatever it is. And advisors, to be honest with you, don't necessarily think about tax consequences. And when I'm sitting down with a tax return and I have to tell the client if they would have taken the 10 from the non-retirement account, it would have saved them an enormous amount of money in taxes, then we have to have a conversation with the advisor. So anytime that you're taking money from your brokerage account, it's imperative that you ask them, I need $10,000, but the most tax efficient way. And it's even more important that your advisor and your tax preparer talk. I never see that happen, by the way. And how are your investments going to do better if you're paying higher taxes? So Vanguard did this study a few months ago, and it said if your advisor and tax preparer are the same or work together, your rate of return is 1% better on your account. Super important that they talk, because 1% in your pocket every year usually will cover your fee if you're paying an investment fee, but it'll also help your portfolio grow over the long haul. So again, just some quick overviews on mistakes I see. I'm not always right, wrong. Again, I'm giving you my unbiased opinion about especially number one and number three. Just personally, when I'm dealing with estate distribution, it's so much easier if things have been consolidated. It's also, I'm telling you, in today's world, I say when I started in this business, I had one client have Alzheimer's, and today I would say it's 25% of my clients have Alzheimer's. And so what you're trying to do by consolidation is just make things easier for the next person that has to come in and take your place to pay bills or take care of your spouse if you're not there, or to pass assets on that you've worked so hard for. So always interested in feedback. I love it at taxandtrusthelp@gmail.com. Thank you so much for your time and hope you have a great day.